Are you ready to make your money work for you in 2023? Want to know where to stash your cash for the best returns? Do you want investments that offer the sweet spot between high returns and reasonable risks? If you're nodding your head, you're in the right place. And hey, while you're here, smash that subscribe button for more financial wisdom. Number 10, rental housing. Rental housing is as hands-on as you can get in the investment world. You're the boss picking properties that could increase in value and bring in regular rental income. It's not just buying a property, it's managing it, finding tenants, and keeping the place in shape. But here's the deal: with a smart buy and good management, rental properties can provide a solid stream of income. Plus, you could benefit from tax deductions like mortgage interest and maintenance costs. And let's not forget the potential for property values to climb over time, which means your investment could grow. It takes more elbow grease than stocks or funds, but for the right person, it's a chance to build serious wealth and cash flow that could pay off for years to come. Number 9. NASDAQ 100 Index Funds. NASDAQ 100 Index Funds are like a VIP pass to the tech sector's brightest stars. This fund is packed with innovation powerhouses like Apple, Google, and Microsoft. It's heavy on tech, which means it can be more volatile. Tech stocks can jump sky high, but also take a nosedive. However, tech is driving the future, and being part of this fund means you're investing in companies that are shaping how we live. It's a growth-oriented investor's dream, especially if you're playing the long game. By investing regularly over time, you can smooth out the highs and lows with dollar-cost averaging, setting you up for potential big wins as these tech giants continue to expand their empires. Number 8. S&P 500 Index Funds. An S&P 500 Index Fund is your way to play in the big leagues of the American economy. It's a collection of 500 heavy hitters. These are the largest and often most successful companies in the U.S. from all sectors. We're talking about names that ring a bell like Apple, Microsoft, and Johnson & Johnson. Investing here is like betting on the overall success of American business. And because it's so diverse, it's less risky than putting all your eggs in one stock basket. It's been a pretty solid performer historically, bouncing back from dips and showing that over the long haul, it can be a strong foundation for your investment portfolio. Plus, it's easy to get into with most brokers offering these funds with super low fees. Number 7. REIT Index Funds. REIT Index Funds are like getting a slice of the real estate action without ever having to fix a leaky faucet. These funds pool money to buy real estate properties including malls, hospitals, hotels, and even apartment complexes. You become a mini real estate tycoon by owning a piece of these properties. And the cool part, these trusts have to pay out most of their taxable income as dividends to you, the shareholder. So it's a steady income stream, which is music to the ears of anyone looking for regular cash flow, like retirees. Plus, you get the chance for your shares in the fund to grow in value over time. It's like having your cake and eating it too, with a side of rental income, all without the landlord headaches. Number 6. Value Stock Funds. Value stock funds are all about finding diamonds in the rough, companies that may have been overlooked or undervalued by the market but have the potential to shine. Investing in these funds is like supporting the underdog in a race, with the hopes they'll make a strong finish. These stocks are usually priced lower than others in their sector due to temporary setbacks or just being out of favor with investors. But here's the thing, value stocks are like a coiled spring, and when they release, the gains can be substantial. These funds are typically less jumpy than growth stocks, which can soar and plummet on hype. Number 5. Dividend Stock Funds. Dividend stock funds are like getting a slice of the profit pie from a variety of companies. These funds pool together dividend-paying stocks, which means you're not just betting on one horse. It's a diverse approach to getting a share of company profits. And here's a fun fact. Dividends are often paid by companies that are well-established and financially stable, so they're less likely to take you on a wild market ride. By investing in a fund, you spread out your risk and give yourself a chance to earn money from different sectors and industries. Plus, if the market does well, you could see your investment grow on top of the regular dividend payments. It's a double delight for those who have the patience to invest for the longer term and enjoy the regular thank you payouts that dividends offer. Number 4. Short-term corporate bond funds. Short-term corporate bond funds are like getting a backstage pass to the corporate world. These funds invest in bonds from various companies, all with maturities typically less than 5 years away. This means they're less affected by the interest rate roller coaster that can make longer-term bonds more of a white-knuckle ride. They can offer better returns than your average savings account or government bond, making them a smart pick for folks who want a bit more bang for their buck without too much risk. They're not FDIC insured, but by spreading your investment across different companies, these funds lower the risk of a single company's flop wiping out your investment. Perfect for those who need some income from their investments and want a little more excitement than a savings account can offer. Number 3. Series I bonds. Series I bonds are like a suit of armor against the dragon of inflation. They're designed to protect your purchasing power because as inflation goes up, so does the interest on these bonds. It's a pretty smart way to make sure your money doesn't lose value over time. And since they're issued by the US Treasury, you can bet they're as safe as investments come. No chance of default here. You can buy up to $10,000 each year, and if you've got a tax refund coming your way, you can add up to $5,000 more. Even better, these bonds keep earning interest for up to 30 years, and you can cash them in after just 1 year if you really need to. But there's a small catch. If you cash out before 5 years, you lose the last 3 months of interest. Number 2, certificates of deposit. Certificates of deposit, or CDs, are like giving your money a productivity plan. You agree not to touch it for a set amount of time, and in return, the bank says, we'll pay you more interest for that promise. It's a win-win. The cool thing is you can choose how long you want to lock it away, from a few months to several years. And the shorter the term, the sooner you can reinvest at potentially higher rates. Think about it. If you're not going to need your cash anytime soon, why not let it work harder for you in a CD? Plus, just like savings accounts, CDs are protected by the FDIC up to a certain limit, so your money is secure. And with some shopping around, you can find the best rates to maximize your earnings without taking on the risk of the stock market. Number 1, high-yield savings accounts. High-yield savings accounts are like your financial guard dog. They keep your money safe while letting it grow. Online banks offer these accounts with interest rates that can be over 20 times higher than what you get from the traditional brick-and-mortar banks. Why so high, you ask? It's because online banks usually have lower overhead costs, which means they can pass the savings on to you in the form of higher interest. And yes, they're super convenient. You can usually transfer money in and out pretty easily, often with just a few clicks. Also, there's no need to worry about your money up to $250,000. It's protected by the FDIC. There you have it, a tour of 2023's most promising investment landscapes. So what are you waiting for? Dive into the details, pick your ride, and let's get that money moving. And don't forget, for more financial tips and tricks, hit that subscribe button.